because you should be able to sleep at night. And if something can happen, always, right? Not everything is in our control. So let me give you the best and the worst deal that we did so far. So our best deal was a 15-month project with a 33% annual return to investors. The worst so far, let me knock on wood. There was a project we did, and because of COVID, we got delayed and some other reasons. So we decided to sell the land, and it took 3 buyers to buy. So the buyers were coming and walking away, but at the same time, we had to pay mortgage.
Hey, fellow savvy real estate investors, thanks for tuning in. We have Michael Kharlab on the show today, so we are excited to have him from CFP Group. He is a fellow Canadian who is doing some great things in Canada and the United States. And many of you know we are also in the United States now. So it's always interesting for us to connect with other Canadians who are actually doing the same thing. He is well established. He has a great track record. They've raised quite a lot of capital and deployed it in various projects. So we're really excited to pick his brain and learn more about how he has done this, over the sort of multiple decades of investing that experience that he has, and to just really understand it from a Canadian perspective. I know that we often talk to people who are doing large syndications and all that, but a lot of them are south of the border. So it's definitely different when you're Canadian doing this, and we can say this from experience. So really excited to have you on the show. Thank you for joining us today. And maybe for our listeners, you can just give us a quick introduction of yourself and maybe tell us just a little bit about what led you to the path of investing in real estate.
Okay, so I spent about 20 years working in IT company. Real estate was really a fluke. A friend of mine came to visit me. It was February 2010, maybe March, and he said he just bought a condo in Miami. And I know after the crash of 2008, things were bad. I just never realized they were so bad. So he showed me the prices, and I was on the plane within a few weeks with my other friend. Going there and buying the first property without knowing anything, like really just went on a plane, did a little bit of research what we want to buy, and we bought the first condo. And I figured out if it's something is cheap and selling at a huge discount, there's not so much room for mistakes. So yeah, we still hold that property to this day. It was 13 years ago. So it's still one of our assets. And then I started doing a little bit more deals. We bought another condo, then we did a triplex. And then I was introduced to Reach That Education. And the company had the different names. In Canada, it was Tigrant and then Legacy. So I did some classes. I took a mentor. And one of the things he told me that I should start working with investors, learn different strategies. And that's what I've been doing since for the past 9 years. Been working with investors, started with 1, then 2. Then the ball started rolling. 2017, I left the corporate world. So I've been doing real estate investing for the full time now. And we've grown to about 150 investors in Canada and the United States, some international as well. So last year we placed approximately $10 million of investor funds in various projects that we participate in. So it's been a journey with upside and downsides. It's never a straight path to success, but I would have done it again. For sure.
Oh, nice. And we're going to get to all of those great things that you talked about. I'm curious to know, what was the price point in for that first Miami condo back in 2010?
Sure. $103,000 US.
Wow.
Wow.
It's worth probably $300 today.
What kind of rents are you getting now?
We just recently rented. We had a tenant for about 12 years and she left. So we got more than $2,000 for the property.
Wow.
But you need to know that for the old condos, you pay a high condo maintenance fee. So it's very high. We started with $600 13 years ago. It's probably $900 now. So the cash flow is not so big, but you get lots of appreciation.
Right.
Yeah, great location.
So, what did you say it's worth today, roughly?
Around 300,000.
300. Okay.
Yeah, that's awesome. So talk to us about that. I mean, as a Canadian, what gave you the confidence to just fly to, I mean, I know we're just, we're north south, but we're still separate countries. And I know a lot of Canadians face this sort of barrier. They, it's still, there's this invisible line, right? And they don't feel comfortable going south. What
Yes.
gave you the comfort to just take the plunge and just go and invest in the United States? And, were there any mistakes that you made or things that you didn't know that you wish you had known with respect to, structuring yourself or taxes or legalities in doing something like that?
Okay, yeah. So I'm not sure why you think I was comfortable. I was not. I just went on a plane and bought. But again, the price there was not much, room for mistakes. We still overpaid. We could have bought it less cheaper, but in terms of mistakes, yeah, the mistake number one, I took a local realtor, and I said, you guys need to establish an LLC, which is limited liability corporation in US, which is awesome for the US investors. It's terrible for the Canadians. It's because the CRA does not recognize LLCs as a flow-throughs. Meaning they say it's a corporation, so the corporation needs to pay tax, and then you, the owner, also need to pay tax. And there's no credit that you get in Canada. They all do it in Florida and in US for US investors, but it's not something that works for us. So over time, obviously, it had to be fixed. So yeah, should have probably talked to a cross-border CPA before doing anything. Maybe we rushed, but it's something, I learned that it's okay to make mistakes on the way. And the person who doesn't make mistake actually does not act or does not produce anything. So
Yeah.
Mistakes are fixable. And if you don't do mistakes, you don't do enough. So hope it
Absolutely.
helps.
I totally agree with that. I mean, if you're not failing, then you're not growing, right? That's what Robert Kiyosaki says that as well.
Yeah,
Now,
absolutely.
kind of going back to, so what were a couple of your next steps after that condo? You did the Rich Dad education. Did you start investing in Canada at all, or were you always then focused on in the US?
No, I started investing in Canada right after that. So I did my courses, I did the mentorship, and as I mentioned earlier, my mentor said you need to start bringing investors. To bring the investor, you as a beginner, you don't have enough knowledge to show somebody what needs to be done. So I decided to partner up with different people for different strategies. So back in the day, I did a bunch of rent-to-owns or lease options. So I found a couple of good people, very successful doing that. And I structured joint venture partnerships with them, meaning they would operate the property, they bring the tenant buyers, and I would bring investors. And obviously, I started doing, first, I needed to do myself before bringing investors on board for two reasons. First of all, you need to show skin in the game, showing you do, and you recommend the partner because your money should be there. Number two, you need to show or to learn how the partner works, because I would bring the investor pretty much at 90% ready to invest by answering all the questions about the process, how the program works, what the potential return, the risks. So that's what I started doing. I've done probably around 15 rent-to-owns as a partner. Okay. And they're starting growing up, doing different deals. So 2015, we started doing duplexes conversion in Barrie, basically buying one property and dividing into two legal suites. Many people did it back in the day. So that strategy as well.
Yeah. So, you did, there's sort of some core strategies here, rent to own, duplex conversions. When did you make the leap into larger apartments and development?
Development, yeah. So it was 2017. If you might recall, in Ontario, the province introduced the new mortgage legislation around April 2017. Timing was terrible for me because I left the corporate world in March. So I was sitting at home and I couldn't do a single deal. It was a tough time. So we decided to go to US and change the business model. And it worked. So I was looking into Texas, and I went to Texas 8 times between 2016 and 17. Couldn't close a single deal. Something just fell apart. But
Now, were you
Arizona
looking
came
for
to-
like land deals or like some just properties, other kind of properties?
It was everything. So we had one deal, one land under contract, and we didn't close because the numbers didn't work in the end. And there were several partnerships I wanted to establish, and again, never panned out. So, and then we also looked at Arizona, and I met one developer from Arizona who needed some investors for his projects, and it was an amazing market back then, still is. And this is how we started doing projects in Arizona. So we changed the business model to partner up with developers, or call them project sponsors. They would be the operation managers doing day-to-day operation of the project, and we would come as a capital arm, bringing our investors to the deal and become partners in the deal. So yeah, it's been 6 years ago.
That's
Oh,
cool.
nice.
Yeah. So yeah, we both have questions.
Yeah.
Talk to us about what your first deal looked like. What is your criteria? What kind of, land development is kind of a big, all different types and all different risk factors depending on what you're doing. So what were your criteria when you were looking, and perhaps it has evolved or changed now? What are you guys looking for?
Yeah, so typically project sponsor come to us, they come to us with projects, and we'll look into that. But the core strategy for the past 6 years was what we call build for rent. There is a huge shortage of rental units in the United States, and we're talking today maybe between 4 to 5 million units that they still need to build and accommodate. So the idea was to buy a piece of land and to build a small rental community, and it's different from building a single homes for sale. It's a different type of construction. It's much faster. You do everything the same in every unit. Then you rent them out, and then you sell it as an income producing asset to somebody who's looking to buy. Or you can refinance and keep, but our investors were in and out, so we needed to pay them back. So that was the core strategy, and still is to this day. We do different types of deals, but we've done probably close to 10 build for rent. So the first deal was a property in Scottsdale. It was 16 units. Scottsdale is a suburb of Phoenix, high-end suburb of Phoenix. It was 16 units. We bought a piece of land for approximately $100,000 per door with permits. And we built, and then we sold it close to $8 million with the developer. So that was a good project. Took about 2 years. And one of the reasons we went to Arizona is because they do not have winters. There's no basement, so you don't need to dig underground. The water retention is very simple. Just let the water dry. And I don't know if it's a good thing to say on a podcast, but there's no unions, right? So you got labor that the people come to work, they go home, no strikes. You don't need to deal with all that. So it's pretty fast. And at that time, back in the day, the city was very fast to issue the permit. So you literally could start and finish the project quickly. Our shortest project was 15 months from the day we closed until the day we exited the deal. 15 months, 14 units. You cannot do anything.
Awesome.
Over here in the GTA, at least, that would be like like it's probably like triple the time just to get the entitlement.
Yeah, so for condo projects for large, obviously they're much bigger than what we did, but it's between, let's say, 6 to 9 years today, start to finish.
Crazy.
Yeah.
So I wanted to, kind of learn more about why you chose Phoenix, and why not some of the other markets. Like, what led you into Phoenix? I know Phoenix has been amazing, one of the hottest markets in the U.S. Crazy growth in terms of everything, rent growth, population growth, all the economic fundamentals were there. But was that how did you come across that? Were you doing market research into other areas besides Texas? And then how did you come across it?
Yeah, so that's exactly what we did. So you look at the macroeconomic point of view, and you look at the area. So Phoenix has been on a tear, growing like crazy for years. They overbuilt in 2005. Obviously, there was a big crash in 2007 and 8, and it took time to come back with the demand. But what happened after the crash is that the government stepped in. So They expanded the airport. I think they took ownership on the airport. That's number one. Number two, they started rebuilding the downtown. They wanted to attract people. So in large cities, with the exception maybe New York, Chicago, maybe Atlanta, LA, normally people do not live in downtowns. Right? They commute to work and they go home to suburbs. And they wanted to change it in Phoenix. So there was a huge amount of apartments for rent being built in downtown, around downtown. On top of that, you look into population growth and migration of people from other states, especially from California. You look into corporations coming into the area because every person that comes to work typically creates around 3 jobs because somebody needs to serve them, right? To sell the groceries or the gas or doctors or lawyers. So on top of that, the University of Arizona is one of the biggest. So they were expanding. So students were coming. And lastly, we should not forget that Arizona is the place for retirees to come. So I'd say anyone east of Chicago goes to Florida mainly, but from west to, and Canadian also, Calgary, Edmonton, they go to Arizona. So many people buy the secondary homes there.
Okay.
And it's a big city. Now, Phoenix was at the time what we call a tier 2 city because there were no big corporations or financial headquarters compared to New York and again, Miami.
Yeah.
But it became tier 1 city. So growth was there. We just needed to catch up.
Right.
Yeah, no, that's pretty cool. So talk to us about, your journey in raising capital, because I know so many of our listeners, capital seems to be a big topic because many investors feel inhibited by the ability to raise capital. And I think that a lot of people who are looking in the US wonder how other Canadians, what their comfort is in investing down south. So talk to us a little bit about your journey. Where are your investors coming from? Are they Canadian investors? And what is the draw or the motivation for them to invest in the United States?
Yeah, so people would invest anywhere if you just can show them how they can make money. That's number one. It just doesn't matter if it's US or somewhere else. That's number one. Number two, most of them, they cannot do large projects themselves. So they would need somebody like us or any other company to help and guide them. So there is an element of trust, and that's the most important thing when you talk bringing capital to anything. So there's 2 ways to raise capital. Number one is to do it for the accredited investors only. Okay. The problem with that is only 10% of population is being deemed as accredited. Okay. So every company that's trying to raise the capital, doing webinars and meetings, they're all fighting for that 10%. Versus we work with what I call busy professionals. So people making good salary, engineers, lawyers, doctors. They might be accredited, might not be. But there is another way. It's in the US, it's called Rule 506 D with the exception B. So if you have a personal relationship with somebody, they can invest in your project. We're not going to go too deep into that.
Yeah.
But
I'm familiar with what you're saying. Yeah.
So from my perspective, I'd rather be working with 90% than 10%. Not to say we're not working with accredited, and most of our investors are accredited, but there's different ways to structure.
Right.
So in terms of raising capital, all these webinars, people just look at company A, B, C, and D, and they're pretty much the same deals. You cannot invent the wheel here because all the projects structure the same. So people just looking at the numbers and the comfort level. But more what people are looking for is the personal relationship with somebody who's bringing the capital. And here you need to spend some time, could be a week, sometimes could be 5 years, to make sure somebody trusts you to invest with you. So when I started, obviously it was people who knew me, my past co-worker, friends and family, and then we started growing because people started referring other people to us. We do not advertise. If you will never find advertising because we're not mass market company, pretty big, but we're not mass market. And it's because we're interested in those long-term relationships with people.
Mm-hmm.
So that's why it took several years to come to 150 investors. But again, it's a slow and steady.
Yeah.
No, that's amazing. I mean, having raised capital myself, especially for our Atlanta deals, we understand the challenges, right? It
Yeah.
takes a lot of work, a lot of grooming, and I understand that you have a investor circle as well, right? So
Well,
tell
that's
us.
the community. Yeah. So before that, I'll tell you that most people, they cannot bring funds to projects. And developers I spoke to, we work with, I would be surprised that they need somebody like us to bring funds to the deal. But, it's a different skill. It's a different skill level. It doesn't come overnight. You need to work hard on yourself. Your communication with people, ability to explain, to show the risks, and not to sell. Like I never sell the projects. The other way, I show all the risk up front, and I tell people, listen, you need to think well before you invest, and it's a skill that you need to build. Going back to investors in a circle, it's just an educational community that we established. It's our way to give back. We don't use it to raise money. There's so much demand for knowledge from people that want to be exposed, and many come and hopefully they see us as experts. So we created this community to teach, to show different strategies, what's possible, the way people can invest. Because majority of investors, people call themselves investors, they do buy and sell, buy and hold. There are so many other strategies around, just people are not aware. So we do it. There's no charge. We get together every 3 months and we just come and educate.
Yeah,
Nice.
no, that's awesome. So maybe talk to us a little bit about the returns. I mean, maybe give us, for our listeners, an example of a deal that you guys have recently put together. Maybe give us some specifications about what it was, what you guys were doing, what the term was, and, maybe like an idea of what kind of returns investors would receive.
Okay, so since we deal with development, it's probably the riskiest strategy that's available. So there's so much risk compared to, let's say, your Atlanta deal where you bought an existing property.
Yeah.
Right. So we expect to compensate people more for the money that they put at risk. Right. So typically we try to structure the project where the return to investors would be between 20 to 25%.
Right.
Annual return. Does it always work? Not always. Right. And especially COVID is an amazing example. I tell people, if it's your last money, you should never invest, because you should be able to sleep at night. And if something can happen, always, right? Not everything is in our control. So let me give you the best and the worst deal that we did so far. So our best deal was a 15-month project with a 33% annual return to investors. The worst so far, let me knock on wood, there was a project we did, and because of COVID, we got delayed and some other reasons. So we decided to sell the land, and it took 3 buyers to buy. So the buyers were coming and walking away, but at the same time, we had to pay mortgage. So that deal, we brought lenders in second position. So those guys did well. They did 18% annual, but the equity partners in the deal, because they had to wait, ended up getting less than 8%, around probably 7.8% annual. Now it's still okay. Nobody lost money, but this is not the return they were expecting, and it happens because it's an investment. Some people told me, Michael, you probably will never tell other people about this deal, and I said, no, I'm going to tell everyone, because you're being tested when things are bad.
Yeah.
Here you need to show what you're capable of doing, and even in that situation, people they made money, not as much as we hoped they would. Right? We as general partners didn't make any money, but people got their invested capital back plus some. But even more than that, that project was 28 homes, luxury homes that we were about to build. And should we continue building those homes and come to the market today, it would have been a disaster, because at the moment, the economical situation is not clear, not sure what's happening now. The mortgage rates are high, lenders are not lending. There's 70% cancellation for the homes to buy in Phoenix. So the buyers are just walking away. Think about going to the market with 28 homes. Could have been a disaster. So preserving of
You
capital.
exited that deal at the right time then.
A little later, yeah,
sometimes-
but
Yeah, sometimes things come in unexpected ways, blessings in disguise, right? So,
For sure.
yeah. So, I mean, yeah, you're right. And I mean, development does have an added risk and therefore does have, better returns often than just like a multifamily syndication deal. So yeah, definitely.
So my question is that from, tell us a little kind of a few objections that you would be getting from raising capital, especially with like development and in a cross-border project. What are some of the objections that you'd be getting kind of more frequent on a frequent basis?
Well, I know the objection up front, so I answered them during my initial call with investors. So I answered the questions before they asked. But typically, probably number one, I need to give you or the project sponsor the money. What happens, how it's managed, how we can assure money is being deployed properly. That's number one. So you need to advise or let them know what the process is, how you transfer the fund, how the title company works, what's title company.
Yeah.
And obviously the second one is the taxation.
Yeah.
And here you need to explain the way the taxation works. The tax treaty between Canada and the United States, they need to fill out the taxes if you partner in the deal. What's K1 form. So that's probably the biggest thing that people don't understand. And I explained how we structure, which type of entity we use. So as the Canadians, in the beginning of our conversation, I gave an example of LLC, which is bad for Canadians. So I also explained how we avoid getting double taxation. So we use different structure. But yeah, taxation, it's probably the most common topic of questions, on top of what happens, if somebody goes under the bus. How they get my money?
Yes.
Yeah. So what is the typical term like for a development deal? What is the typical capital commitment?
I guess what are some of the minimum investment from the investor point of view, and like what's your typical term look like?
I understand. So for us, the minimum is $50,000. So the project is in Canada. It's in Canadian currency. If it's in US, it's obviously in US dollars. And it's connected to the question of accredited investors before. We're not mass market company. We're not some crowdfunding portal that can accept money from small investors. We work with accredited or sophisticated, and I want to make sure this is not their last money. So that's why the threshold to start with us is pretty high. For that reason, in terms of timing of the project, is typically between 2 to 3 years.
Nice.
And to finish.
No, that's amazing.
Pending there is a COVID.
I mean, depends on a person's perspective, but I mean, 50,000 I think it's a reasonable amount. I know that, if you typically, when you go through the exempt market world, they're usually 25,000 or sometimes even lower. But yeah, that's definitely another avenue for some people. Some people, yeah.
Well, the difference between EMDs or exempt market dealers and us is because people work directly with us. We participate alongside with them in the projects. We also invest, and they get direct access to us. I cannot properly serve 2,000 investors. There's only X amount of people I can give my attention to because they can access me, they can call me.
Right.
And I usually reply very fast. So that's the difference between us. Again, it's just choice. I'm not saying anything is better than other, right? But that's how we operate.
Yeah. And I guess what does your typical day look like, Michael? Is it more like you're analyzing deals, investor relations, all of the above?
Yeah, so I do mainly the investor relationship. So the existing and new. I do a little bit of business development, meaning initial conversations with potential partners. And if it's something that can be worked any further, I bring my partner in. I don't do due diligence. He's much stronger and knowledgeable in what he does compared to the project. So he would analyze the deals and do negotiations with the partners and prepare the paperwork. The moment this project is a go, I step in and I work with investors. My typical day is that's what I do. So a lot of work with investors, existing, new people call me. I do a bit of marketing, so you guys interview me, some other people, but mainly meetings with people who either invest with us and they come, want to talk, or the upcoming investors, potential investors, or partners who want to do deals with us. So that's...
Yeah, for sure. So maybe talk to us a little bit about the market. And, we're in 2023 now. This time last year would have been maybe a different conversation. So there's lots of investors out there who are wanting to hear more about what the market is doing and how other investors are adapting or changing strategies or, whatever they're doing to cope with the current market conditions. So maybe talk to us a little bit about how you feel about the current market and what you anticipate for your company in 2023. Is there a different direction? Are there different types of projects you're looking at? Is there any kind of pivot or change to, adapt to the environment right now?
Yeah, very good question. So yes, the market this year is different compared to last year. And it's supposed to be like that because it cannot go up forever.
Yes.
If you go back to the beginning of COVID, for the past 2 years, people were sitting at home. There was nowhere to spend the money, and so they decided to invest. So they invested in crypto, they invested in stock market, they invested in real estate, and all three went up. I don't know, but probably like double in the amounts. Whatever goes up that fast has to come down. Because at some point of time, the next buyer says, well, it became too expensive, I'm not going to buy, and then it becomes a snowball. So to adapt to a market, you as an investor, you need to adapt yourself to the conditions. Meaning, if something is going up, you can buy and make money if it continues goes up. Or what we do, we create a product, we develop, we create, and we sell it at a high price. If the market goes down, then yes, it's a good question that you ask, and yes, we're going to change the strategy. So we're going to start looking into buying because now it becomes cheaper. But also we're going to start looking into different states and into different strategies. So I'll give you an example. We just partnered up and we bought a hotel in Lake Placid. So that's going to be something that's income producing. So that's one industry that I think is going to thrive this year because people are sitting at home for too long. So anything related to travel, I think it's good. The second one, we're looking into assisted living. So it's like a nursing home. It's a still development deal with something that can be done, kept for a long time. And it does not depend on the economy. Okay, so that industry is, unfortunately, people get sick. So you're going to continue getting income if you do it properly. And number three, we're going to look into further into do land development deals because people still need to live somewhere. More houses are needed. I mentioned that there's a shortage of between 4 to 5 million homes in the United States. So yeah, we're going to continue building. We're probably going to continue building for rent, right? Because unfortunately, what happened is if somebody, let's take Las Vegas, for example. I think you needed about $42,000 to buy a house in Las Vegas 3 years ago, a salary of 42.
Yeah.
I think now you need around 84.
Wow.
So I don't know how many people you know that doubled their salary in the past 3 years.
Yeah.
But the property value doubled, meaning most people will continue renting and probably there will be maybe even a whole generation of people who would not be able to buy.
Yeah,
so there will be huge demand for rent. And if you can come with a product for rent, this is something that you can do. And I think that's what we're going to continue doing. So if it's development only for rent,
yeah.
And if the market, goes down even more, we'll start looking to buying.
And yeah, for our listeners' sake, can you explain what's the difference between a multifamily and a build to rent, and why you have chosen the build to rent route versus developing multifamily?
Yeah, so multifamily typically it's for lower income people. So nothing bad with that, but it's the rent and the population. And when the economy is bad, some of those people lose their jobs. This is low-paying jobs, and you need to work harder to replace them or to collect the rent. Versus with the build for rent, you target what's called renters by choice, or A class properties, right? So those are people who just decide not to buy, or they work, they make good money, but cannot get a mortgage today these days, right? So they're okay paying rent. So those typically would be what we call white collar people, engineers, doctors, lawyers. They have no problem paying rent, and they have no problem paying more than what you would charge. So those are the communities. It's homes. You don't build vertical, lower construction cost. It's a gated community in Florida just for rent. So it's a product for, I wouldn't say niche, but it's not a product for everyone. With that being said, there's just so much shortage of rental homes or apartments. So there is a property for everyone. So we prefer to be building and renting for people with higher income.
Okay.
Yeah.
Well,
No, that's
nice.
a great niche, and some great points you brought up about some of the struggles with traditional multifamily for sure. So different strategy, different target. And yeah, no, that's really cool. Really, I think I learned something I didn't quite realize that there was such a product. So that's really awesome. So, I mean, talk to us about, your vision for the company. I mean, over the next 3 to 5 years, what do you hope to do, and where do you hope to take the company?
Well, I think we hit this sweet spot in terms of amount of investors. It's a good, decent number. So probably will grow by 25, 30%. At some point, I would have to say stop. I cannot take any more calls, right? We're a small company. We want to stay small. It's convenient for us. So I'm not a visionary like Elon Musk. I'm not here to change the world. I'm here to help people, as many as I can, but I can't help everyone. So we're going to bring some more investors to our projects. In terms of the amount of money we bring to the deals, maybe we did 10 million last year, so maybe we'll do around 15. That's probably 20, maybe the maximum we would be willing to do. So yeah, that's pretty much it. So it took 5 years from the moment I left the corporate world to come to this point. And we got many repeat investors. So every time we exit the project, most people say, what do we do next? So there's not so much need for us to look for new capital. There's a very good core group of people that working with us. Probably I would do a little more education, sharing the knowledge, doing more events, educational events, which is, share my experience, what I was able to do. That's pretty much it, right? Enjoy life, right?
So nonchalant. That's just it. We're going to bring 20 million next year. No big deal. Oh, that's pretty awesome.
Well, you said 3 to 5 years. I didn't say next.
Yeah. Yeah, no, for sure. That's great. I think I learned a lot. I think, your strategies is great. And I commend you for your success and being able to convince all the Canadians to get on board and start investing their money, because I think that we are generally a conservative society, and
sure.
Definitely is a challenge to build that trust and to educate people enough that they understand. And Jose and I both believe that investing is not a choice anymore. It's a must. You need to have your capital working for you, especially with the economy the way it is and the cost of living. And we could go on, but everybody should be investing their money in some form. And we believe as well that real estate is the best vehicle to get you there. So
yeah, I'm with you. There's so many options that real estate gives. And depreciation, it does not depend like a stock market on what other people think or do. Yeah, so I agree with you. And these times, with the high inflation, you need to protect your capital. So real estate is one of the best vehicles out there. And
Absolutely.
thank you for the warm words. Yeah.
So
yeah, Michael, what's the best way for people to get in touch with you? You have cfpgroup.ca. And by the way, I just to touch on that, how did you come up with the name Connect Fund Profit?
Yeah, so it used to be Cash Flow and Properties. And then we did some rebranding during COVID. We had time to think. So yeah, we were thinking what CFP stands for, and in comparison to what we do, because pretty much we connect the investors with the project sponsors, right? We're people in between. We're not brokers. We participate in the projects. Yeah, but that's what we do. So we connect, we fund the deals, we profit together, and just repeat.
Yeah, beautiful.
That's awesome. So we'll
so cfpgroup.ca, that's our website, and you can look me up on LinkedIn, Facebook, and
Absolutely. Okay, fantastic. And I know that people can schedule a 15-minute strategy session if they're interested in investing in any of your projects. So we'll definitely link all of that in our show notes. I think that, our listeners would have got great value from our conversation today. We certainly did. Thank you for giving us your time and sharing your experiences with us. We really appreciate it very much.
Thank you so much, guys.
Thanks.